Okay, so good morning, everybody. Are we online already?
Yes.
Okay, so good morning, everybody. Welcome to the Risk and Regulatory Academy 2020. This is a special series of events that as Deloitte Central Europe, we decided to organize and to present the most interesting topics and discuss them with you within 5-day webinars. We selected the most interesting topics, starting from credit risk, BASEL II, to supervision, IRBBB, and non-financial risk. And we invited Deloitte speakers, the best Deloitte experts, subject matter experts from 7 countries, and we have 21 subject matter experts. So I hope you are joining today, but you also will join any other session that you will find interesting. This series of events is intended to be a regular, so we are starting this year, but our intention is to also present to do this kind of event next year. So it's more than welcome to have any feedback from you regarding topics that you are interested in, that how do you found it, and which especially in particular parts you found interesting. As I mentioned, today we will talk about BASEL IV, one of the events that was, let's say, very often mentioned and one of the hottest topics in BASEL II and banking industry from risk and regulatory perspective. Today we have experts from France, Paul Hervé, which is reading credit risk in France. So welcome. We have Michael Kluse, which is our BASEL IV initiative leader in Germany, but what is also very important, he's leading this initiative for Deloitte in continental Europe. And we have Ewa Winiarska from Poland, which is our expert in BASEL IV topics. So today, the agenda for today is to start from the short, let's say, more than 1 hour presentation by Michael and Ewa to tell a little about BASEL topic, how we see it, what's going on. And later we'll move to the panel discussion, where we'll also make a poll questions, and your answers will be very important for what we later are we going to discuss. And the final part will be Q&A session. We'll let some time for questions from you, so please write them. And maybe a few words about how the webinar is organized. So please type your questions into the chat box. Only the organizer can see them, so don't worry if you don't see it. You will be able and you will be allowed to participate in the polls by clicking on an answer option on the screen. So the polls are anonymous, but later we'll see the results and we'll discuss them. The audience is muted by default, so the only, let's say, option to communicate is our chat. That's probably all from the beginning, and I believe we can move to the next part, the presentation. So Michael and Ewa, the floor is yours.
Yes, thank you. Good morning and welcome also from my side. We're going to start with a brief overview. What is BASEL IV? And well, is it BASEL III final? BASEL 3.1 as the British regulator currently put it, or is it actually BASEL IV? Before we go into the details, I would just like to start with a short view at the history. And that starts with the document that was published in 1988. In retrospect, it has been labeled BASEL I, and that introduced for the first time a capital ratio of 8%, meaning that every bank must demonstrate to the regulator that there are own funds to cover any potential loss. That was a very simple rule, and the famous BASEL II rule set then made it more risk sensitive, looking at internal approaches, especially for credit risk, which was a novelty that came with BASEL II, and it also included market risk. The rules had been redefined earlier, And then for the first time also capital requirements for operational risk had been introduced. That was just slightly before the international financial markets crisis, and the regulators noticed that the rules were not working as intended. So shortly after implementing Basel II, the regulators came out with a new set of rules. Numbering then was Basel III. And in the first step, the regulators first of all looked at the capital side. So what is capital? They made a clear requirement that any regulatory capital should be able to absorb losses. So it should be capital of good quality. They introduced several capital buffers to make sure that even when losses occur, banks can afterwards still meet the 8% requirement. They introduced the leverage ratio to have an additional backstop, which is not risk-based. And for the first time, they also looked at liquidity requirements, making sure that not only the capital side is sufficient, but also the liquidity side. These have been steps that were taken quite quickly after the financial markets crisis. There have been some minor adjustments to the risk side of the equation, but that was not the main focus of Basel III. Basel III mainly looked at the capital side. After the financial markets crisis, the regulators took some time to really investigate RWA, what drives the risk, how risk sensitive are the approaches, and then they started a lengthy consultation process, which ended in 2019, and they came out with a document they called the finalization of Basel III. The media, advising companies and so on, they dubbed it Basel IV, a term that you will not find on any website of the regulators. The regulators always speak of Basel III final. We call it Basel IV, and as I said, the PRA, the British regulator, now calls it Basel 3.1. It's all the same thing. We're now looking at a revision of the standardized approaches. The use of internal models has been reassessed. In some cases, as we will see, the use of internal models will be limited. One of the means to limit the use of internal models is the so-called output floor. We'll explain in a few minutes what that means and how it works. And they also looked at the leverage ratio requirements and introduced some additional requirements for the largest banks for the global systemic relevant institutions. But basically, that was introduced with Basel III. It's still the same three pillars: minimum capital requirements, the supervisory review as pillar 2, and then market discipline. As I said, in 2019, the Basel committee agreed on the final package, and originally it was meant to be implemented from 2022 onwards. Earlier this year, as a response to COVID-19, the BASEL committee decided to postpone the implementation by 1 year. So as of now, 1st of January 2023 is the date where the new set of rules shall apply. So that includes the new standardized approach for credit risk. It includes the standardized approach for operational risk. We have some revisions to the IRBA, the internal ratings-based approach for credit risk. We will see modifications for CBA. Earlier, we already saw changes to counterparty credit risk. The Basel Committee agreed on these changes before 2019. And that's the reason why the European Commission was able to include the changes to CCR in the CRR2, which became final 1.5 years ago. And these changes will apply from mid-2021 onwards. It's part of the overall Basel package, but as I said, it has been agreed upon earlier, so in the European Commission, it will apply from 2021 onwards. Also, the requirements for securitization exposures have been modified. That's another package that the Basel Committee agreed upon earlier. That was part of a different set of rules in the European Union, and these rules apply already since the beginning of 2019. And for any deals that were made in 2019 and since the beginning of this year, for all existing securitization exposures that the bank had in the portfolio prior to 2019. For market risk, we have also one special rule, and that means that with the beginning of CRR2 implementation, banks will have to report capital requirements that would result from the new rules for market risk under this new standardized approach. They are not binding as capital requirements, but the regulators want to gather information what the impact of the new rules would be. So there are reporting requirements also starting mid-21. Operational risk I already mentioned, and then there are the capital floors. The capital floors will apply from 2023, starting at 50%, meaning that the capital requirements cannot be less than 50% of what it would have been if a bank would be using standardized approaches. And it will then increase 5% annually until in 2028 we finally reach a floor requirement of 72.5%, limiting the benefit that a bank can get from using internal models. So that is the official Basel timeline. The interesting thing is that obviously the Basel documents do not apply directly. They need to be transferred to European law. This will be done by changing the capital requirements regulation. So we're waiting for the draft of a CRR3. This draft had been expected for the second quarter of 2020, but due to the pandemic, the European Commission changed priorities, and then it was announced for later this year. And a couple of weeks ago, the Commission made another statement that they will gather additional information to see, taking into account also the effect of COVID-19, what it would mean for the overall capital requirements. This means that so far we have not seen a draft of the future CRR3. What we hear from Brussels is that probably it can be released either before year end or in January. So that's when we will know what the final set of what the first draft of the European rules could look like. If we have a look at previous rulemaking process in Brussels, I assume that it will take like 2 years approximately until the Parliament, the Council, and the Commission agree on the final rules. So probably by beginning of 2023, we have the final decision. So it's very unlikely, in my opinion, that the new set of rules will apply in Europe in 2023. If the Commission is very fast and everybody agrees on the new set of rules, it could be like 2024, because typically the banks are granted a 2-year period to modify the IT systems. And as we will see in the next 1 hour approximately, there are many changes that will be required to the IT systems, also to capital management, capital planning. So this will take time, and therefore, as I said, it's highly unlikely that the new rules will apply from 2023 onwards, probably 2024. We have to wait and see how fast the progress in Basel is. Nonetheless, and I think we can also demonstrate that in the next hour, we encourage you to look at the new rules earlier than that. You don't have to wait until the rules are final. And next is Eva, who will give you a brief overview of what changes you are to expect.
Okay, thank you, Michael. So now I will describe you in short the changes that are introduced by Basel IV to credit risk, both standardized and IRB approach. But first of all, what is the reason for these changes? Why does Basel IV changes the approach to credit risk? So the main goal of Basel IV was to reduce excessive variability of risk-weighted assets, because during the financial crisis, many market participants just lost faith in the bank's capital adequacy ratios, and the aim of Basel IV was to restore credibility of risk-weighted assets. And it was supposed to be accomplished by three means. So first of all, Basel IV enhances the robustness and risk sensitivity of standardized approaches for credit risk and also for operational risk. Second of all, Basel IV also limits the use of advanced methods. And third of all, it introduces some new measures, and this is finalized leverage ratio and also capital floors. Now let's focus on credit risk standardized approach and what changes in this area. So Basel IV reduces dependencies on external ratings. So it limits the use of external ratings, but also when we use external ratings in standardized approach, there is an additional requirement of mandatory internal due diligence, which means that if we use an external rating, at least once a year, we need to perform an analysis and internal due diligence to check whether this external rating reflects the risk profile of our counterparty correctly. And if not, then we need to adjust the risk weight accordingly, but only conservative adjustments are allowed. So if the risk profile of the institution is not reflected correctly in the way that the risk weight should be higher, then we need to adjust the risk weight and make the risk weight higher. But if actually the actual risk profile is lower, then we cannot lower the risk weight. So only the conservative approach here is possible. So this is the first change, the first area of change. Then second of all, we've got more differentiated methods to derive risk weights. So we've got a new method for assigning risk weights for exposures secured by residential and commercial real estate. We also have a new method for unrated institutions, and we have a recalibration of risk weights for many different exposure classes. I will be talking about it in more details on the next slide. We also have a recalibration of CCFs. So first of all, CCF of 0% is not available anymore. The lowest value of CCF is 10%, which can be used for the low risk exposures. For other exposures, for most of them, we will use a CCF of 40%, no matter the exposure maturity. So this is also quite different than what we have right now. And then we've got a revised definition of exposure classes. So the new exposure classes put stronger focus on the type of borrower and the purpose of financing. For example, for retail exposure class, we've got new criteria to define retail exposures. We also have some subclasses separated in terms of corporate exposures, for example, but also in terms of retail exposures, so that we have different rules for assigning risk weights to these subgroups. So this approach is just more sophisticated than what we have right now. And of course, there is the output floor. Even if banks use IRB approach, they still need to calculate capital requirements according to standardized approach. Because when we use IRB approach, we need to check whether our capital requirement meets the output floor. And the output floor is defined based on the value of capital requirement calculated according to standardized approach. So in order to check whether we meet this capital floor, we need to have some kind of double calculations here. So as you can see, the changes to credit risk for standardized approach are quite significant, and also they require new calculations, new estimations in order for both standardized approach but also for IRB approach. And now let's look in some more details on a standardized approach. So first of all, for all classes, risk classes for which we use external ratings, we've got some changes. The first change is that there is a slight change in the mapping between external ratings and risk weights. So for some ratings, the risk weight according to Basel IV is actually a little lower than what we have right now. So this change is in favor of banks. But then there is also this requirement of mandatory due diligence. So for banks, for multilateral development banks, for corporates, if we use external ratings, then at least once a year, we need to perform a mandatory internal due diligence in order to check whether those external ratings reflect the risk profile of our counterparty correctly. And if not, then we are required to make the adjustment of risk weight, and only those upward adjustments of risk weights are possible here. Then regarding institutions, we also have quite a significant change for unrated institutions, because right now when we have an unrated institution, we assign risk weight that is based on the external rating of the central counterparty in which the institution is located. And Basel IV doesn't allow for this approach anymore. So according to Basel IV, if we have an unrated institution, then we need to assess this institution internally. We need to assign a grade to each institution, and we can assign a grade of A+, A, B, or C, and based on this grade, we will assign risk weights. And this grade, of course, should reflect the risk profile, the risk level of the institution. It should be based on some qualitative characteristics, but also there are some quantitative measures that should be taken into account. And in particular, it's the capital adequacy ratio, and it's also leverage ratio. So as you can see, we will need to gather much more information about our counterparties, which are banks, than what we have right now, and we will need to analyze them much more in much more details than we do right now. So this is for banks. Then in terms of corporates, we've got, of course, we also have those requirements regarding external ratings. But also Basel IV requires us to divide a corporate exposure class into two groups. We've got general corporates and we've got specialized lending. And for specialized lending, we assign risk weights differently. So first of all, for specialized lending, we are not allowed to use external issuer rating. So if we've got an issue rating, then we can use it. But if we have a counterparty rating, we are not allowed to use it. We just need to assign a risk weight according to other general rules stated by Basel IV. And risk weights are assigned to specialized lending based on the stage of the project, the phase of the project, and also the quality of the project. And for example, for project finance in pre-operational phase, we are required to assign a risk weight of 130%, so quite high. For operational phase, we usually assign a risk weight of 100%. But for some good quality investments, we also can assign a risk weight of 80%. So here also some more information is required and more detailed analysis of our counterparties. And also Basel IV introduces a new risk weight for SME clients. So in CRR, we've got the SME supporting factor, which decreases the risk weight that we assign to SME clients. In Basel IV, we don't have such a factor, but we have a different risk weight that should be assigned to SME clients, and this risk weight is 85%. So also slightly different approach, but the main idea is similar. Then we've got retail portfolio, and for retail portfolio we've got a few changes as well. So first of all, we need to divide our retail portfolio into regulatory retail and other retail. And regulatory retail are those exposures to individuals which meet all of the definition criteria that allow us to assign an exposure to regulatory retail class. And the criteria are similar to what we have right now for retail class, but there is one additional criterion which says that the aggregate exposure to one counterparty cannot be higher than 0.2% of the overall regulatory retail portfolio. If those conditions are met, then we can assign an exposure to regulatory retail portfolio and we can assign a risk weight of 75%. But if not, then we need to assign a risk weight of 100%. And additionally, in terms of regulatory retail, we can separate a subgroup which is called transactors. And transactors are those exposures to credit cards and also charge cards where the balance has been repaid in full at each scheduled repayment date for the last 12 months. And these specific exposures can have a risk weight of 45% assigned. So as you can see, the risk sensitivity of this standardized method is really enhanced here. So we've got more differentiated risk weights assigned. We've got more sophisticated methods for assigning the risk weights. For equity exposures, we also have a recalibration of risk weights. We've got an additional risk weight of 400%, so quite high, which should be assigned to speculative equity exposures. We've got a completely new method for assigning risk weights to exposures secured by residential or commercial real estate. And I will talk about it a little bit later on the next slide. Also for retail exposures and for exposures secured by residential real estate, we've got a multiplier introduced, a multiplier of 1.5, which should be used to increase risk weight for these exposures which are denominated in a currency that is different than the currency of income of our borrower. So in case of such FX mismatch, we need to increase the risk weight by 50%. So something new here. In Poland, we've had similar approach. It wasn't a multiplier, it was just a risk weight of 150% before CRR was introduced. So we will be coming back to something similar after Basel IV is introduced, but I believe that in other countries it will be something completely new. And of course, the off-balance sheet items, so CCFs, as I've mentioned before, CCF of 0% will be eliminated. The lowest value of CCF possible would be 10%, and it would be used for low-risk exposures. And for other exposures, for most of them, we will use a CCF of 40%, irrespective of the exposure's maturity, instead of 20 and 50% that we have right now. And there are some additional criteria based on which we will be required to assign a CCF of 50% or 100% or also 20%. So this is also the values of CCF is changed, and also the criteria based on which we are assigning CCFs are also changed. Now let's go to the next slide and let's look at in some more details on exposures secured by residential and commercial real estate. First of all, here, Basel IV introduces a new additional eligibility criterion for collaterals in the form of residential or commercial real estate. And this criterion says that the property securing the exposure must be fully completed. There are some exceptions. The exception is land and is forest and agricultural land, and also some two minor exceptions are introduced. But in general, the property must be finished in order to consider it eligible for the purpose of assigning risk weights. That's quite an important change here. And also, we've got a new method for assigning risk weights. The new method is based on LTV ratio. So the risk weight assigned to exposures secured on residential and commercial properties is different for residential properties and different for commercial properties. It differs based on the LTV ratio, loan-to-value ratio, and it also differs depending whether the repayment of the loan materially depends on cash flows generated by the property or not. If the repayment is dependent on cash flows, the risk weights are a little bit higher. If not, they are lower. And one more important thing here is that when we calculate LTV ratio for this purpose, we need to keep the value of the property at the level from the origination date of the loan. So if we've got increasing market prices in terms of properties, we cannot increase the value of the property for the purpose of calculating LTV and then assigning risk weights. We need to keep the price of the property at the level from the origination. If the prices are dropping on the market, then we are required to also decrease the value of our property. So again, only the conservative adjustments are possible. The only situation in which we can increase the value of the property for this purpose is when there are introduced some modifications to the property that actually increase the value of the property. But otherwise, we need to keep the value of the property at the level from the loan origination. So this is also quite important in this area. And here, when we are using this approach, we don't have the rule that we have right now. So we are not splitting the exposure into parts as we are doing right now. We are just assigning one risk weight for the whole exposure depending on the LTV value. But there is also an alternative approach defined in Basel IV, and the alternative approach is quite similar to what we have right now. The local regulator is required to decide whether we should use the approach based on LTV ratio or we should use the alternative approach. So this is not the decision of the bank, this is the decision of the local supervisor. And the alternative approach, so it's similar to what we have right now. So we are splitting the exposure into parts, into the part that is fully and completely secured by the collateral and the part that is not secured. And we are assigning different risk weights to the secured part and different to the unsecured part. But the parameters based on which we are doing this splitting are different. So first of all, the multiplier that defines the fully and completely secured part of the exposure, right now it's 80% for residential real estate and 50 or 60% for commercial real estate. In Basel IV, it will be 55% for both commercial and residential real estate. And also risk weight that can be assigned to this secured part is different. So right now we've got 35% for residential real estate and it will be 20%. And for commercial real estate, it will be 60%. As you can see, this algorithm, this new algorithm in alternative approach works. So some part of it is more favorable to what we have right now. because we've got lower risk weights for the secured part of the exposure, but at the same time we've got lower multiplier. So to smaller part of the exposure, we can assign this lower risk weight. So it works both ways. So it's not so easy to tell from the beginning which risk weight, which approach will be more favorable. Actually, the alternative method gives similar results to what we have right now. In terms of the method based on the LTV, whether we are the risk weight is lower or higher than what we have right now, it depends on the value of the LTV, of course. And as far as I remember, for exposures that are secured on residential real estate and when the repayment is not dependent on cash flows, the threshold is around 80% LTV. So if the LTV is higher than 80%, I think that we've got a risk weight higher than currently. And if it's lower, then we've got the more favorable approach in terms of Basel IV. Also, Basel IV introduces an additional risk weight of 150% for exposures which are secured on residential or commercial real estate when the prospects of servicing the loan materially depends on cash flows and when the property does not meet eligibility criteria. So right now, when we've got an exposure that is secured on a commercial or residential real estate and the property does not meet eligibility criteria, then we treat this exposure as an unsecured exposure and assign a risk weight that should be applicable to this counterparty to other unsecured exposures. And the Basel IV changes this approach because it says that if we have an exposure that is secured and the repayment materially depends on cash flows, but the property does not meet eligibility criteria, we cannot treat it as unsecured exposure. We need to assign a risk weight of 150%. And also, Basel IV introduces a new treatment of land acquisition, development, and construction. So, for example, exposures to developers need to have assigned a risk weight, in general, 150%. There are some exceptions, and if some specific, quite strict criteria are met, we can lower this risk weight to 100%, but in general, it will be 150%. So as you can see, for the standardized approach, we've got quite a few changes, and the important thing here is that some of the changes will increase your risk-weighted assets, but some of them will decrease the risk-weighted assets. So it's very hard to say upfront what would be the impact of Basel IV implementation on your capital adequacy ratios, on the value of your risk-weighted assets for standardized approach. In order to check whether it will decrease or increase your risk-weighted assets, you really need to analyze your portfolio structure, your portfolio quality in order to determine this, because you cannot say it upfront. There are just too many changes that are working in different directions. And now let's look at IRB approach. So the next slide. And we also have quite a few changes in terms of IRB approach. First of all, as Michael already mentioned, we've got a limitation of the use of IRB approach. So we are not allowed to use advanced IRB approach to banks and large corporates anymore. Only foundation IRB will be allowed for those counterparties. And because BCBS says that banks and large corporates, those are low default portfolios. Those are portfolios for which we don't have too much data. And that's why we are not able to estimate all of the risk parameters reliably. And that's why we can only use foundation IRB for those exposures, and we are not allowed to use advanced IRB approach anymore for them. And also we've got the discontinuation of foundation IRB for equity exposures. So for equity exposures, we will be able to use only standardized approach. And as you remember from the slides before, for equity exposure, we also have, for standardized approach, we've got this recalibration of risk weights, and we actually need to assign for at least some of them higher risk weights. So this will also influence banks that use IRB approach. Then, second of all, we've got some more restrictions in terms of estimation risk parameters. So the input floor for PD parameter is changed, and it's higher than the current one. So the lowest value of PD that we can use according to Basel IV is higher than what we have right now. And also we've got additional floors introduced for LGD and EAD parameter. So also a change here in the way that we are more conservative than we were before. We've got some changes in terms of credit risk mitigation techniques. We cannot use double default approach anymore. So for guarantees, double default approach is eliminated. And we also have quite a few changes for foundation IRB. First of all, we've got a recalibration of LGD values. LGDs for both secured and unsecured part are changed, and they are in general lower than what we have right now. And we also have a different approach for treating collateralized exposures in foundation IRB in terms of physical collateral and exposures secured by mortgages. Because what we have right now in foundation IRB, we are splitting the exposure into parts, and we assign different LGD for the secured part and for the unsecured part. And we've got this minimum collateralization ratio, and we also have the required collateralization ratio. According to Basel IV, this approach will not be used anymore. Instead, we will be calculating adjusted LGD value, and we will use this adjusted LGD value to the whole exposure. It will be similar to what we have right now for financial collaterals, actually. And the final change is the scaling factor. So right now we've got a scaling factor of 1.06 that is used in the formula when we calculate risk weights, and this scaling factor is eliminated. So also the risk weights will be lower here. So those are the changes in terms of IRB approach. As you can see, we've got quite a few of them, and similarly to the standardized approach, some of them will work in favor of the banks. So some of them will decrease the risk weights, and some of them will increase the risk weights. So it's also quite hard to say upfront what will be the impact, the general impact of Basel IV on IRB banks. We need to just analyze in more details portfolios of the banks. And in terms of IRB, we've got one additional quite important change. It is output floor. So as I've mentioned before, each bank that is using IRB approach will need to calculate capital requirements according to standardized approach as well, in order to check whether this output floor is met or not. And more details about the output floor will give you Michael. So now I will just give voice to Michael, give it back to Michael, and thank you very much.
Thank you, Eva. Before I go into the details with the output floor, there have been two questions on the standardized approach I would like to answer. The first one relates to the LTV calculation and how to do that when you have a multiple relationship. The Basel framework is pretty simple here. It assumes that you have one collateral, one piece of real estate which relates to one loan. So you have a clear relationship between the value of the property and the loan. What we see in practice is that you have like two buildings which jointly serve as collateral to 3 or 4 loans. So you don't have this one-on-one relationship. The Basel paper doesn't say too much about how to calculate the LTV in these cases. Basically, it's only a footnote. I assume that the EBA will release a technical standard or a guideline detailing how to proceed in these cases. My fear is that it's not just a 4 or 5 page document, but that we will end up with 50 pages, making it very detailed and very complicated. For the time being, as there is no strict requirement how to do it, when we did support our clients in impact analysis, we tried to optimize it. So we assessed the value of the collateral, we assessed the loans, and then we tried to find a relationship which led to the lowest capital requirements. As there is no clear guidance on how to do it, we assume that it's okay to optimize it. But if the EBA publishes something in more detail, there hopefully will be a clearer guidance how to proceed in these cases. So we
yes, but here also, yeah, if I can add something, because we've got quite a similar situation right now, right? Because we also have some cases in which we've got 2 collaterals for 3 loans, for example, and we still need to make some kind of allocation in order to calculate risk weights. And here, very often, at least in Poland, it is seen that the allocation of collaterals is something a little bit independent on calculation risk-weighted assets, because you use this allocation not just for the RWA calculation, but also, for example, for impairments. And now let's ask a question whether it actually makes sense to allocate collateral differently for capital adequacy and differently for impairments. Probably not very much. So maybe this is the approach here. The questions might be quite similar to what we have right now. Let's hope that we will have some additional rules published about how to treat it. If not, then probably we will end up to something similar than we have right now.
Absolutely. Whatever approach you choose, it should be consistent for impairment, for the internal capital adequacy calculations, ICAP, and for regulatory reporting. For the second question we received, that was the due diligence process. I'm afraid the answer is basically the same. We will have to wait for details. The question is how good the internal assessment was and how it relates to internal ratings. Currently, we assume that if you have a good working internal rating model, and you say, let's say, if the internal rating is 5 or worse, the risk weight cannot be better than 50%. If the rating is 8 or worse, it cannot be better than 100%. We assume that such an approach will be sufficient, but we will have to wait for more clearer guidance from the Commission, from the EBA, to understand what they expect in detail. The clear message is if the internal assessment of the risk weight comes to the conclusion that 20% or 50% risk weight would not be appropriate for this exposure, then you must use a higher risk weight. How you derive this higher risk weight is not yet specified, and again, I assume that the EBA or the Commission will make clearer remarks on what their expectations are. Okay, so that was an introduction into the changes to credit risk, and Eva pointed out that the standardized approach will be relevant for all banks, because banks using internal models like the IRBA for credit risk or internal market risk models, these banks will have to do the standardized and the internal approach calculations in parallel, so that you have sufficient data for the floor. I would like to start with a quick overview of how the output floor works. And the beginning of the whole discussion was a discussion in Basel at the committee, where especially the North American participants raised the question whether the internal models lead to sufficient capital requirements. The North American regulators had the impression that banks were using internal models, credit risk and market risk, to lower the overall capital requirements, and that the outcome would be too low to provide a sufficient cushion against possible losses. There was also discussion of completely abolishing internal approaches. They did decide not to go that way, but instead they introduced the output floor. And the output floor means that the overall relief that you get from using internal models cannot be more than X% of the capital requirements as they would have been if a bank would be using the standardized approaches. There was a long and hard discussion in Basel of what the appropriate floor level would be. The European side said that they would not agree to a floor that would be higher than 70%. The North Americans said that the floor must be at least 75%. So ultimately, they agreed on a floor level right in the middle, and that is 72.5%. Especially the European banks will be hit hard by the floor. We've seen in the impact analysis that the BCBS and the EBA conducted that for most banks under Basel IV, capital requirements will increase. And the increase will be especially high for those banks which currently use internal models, and that part of the increase can be attributed to the output floor. So to make sure that banks have sufficient time to raise capital and adjust portfolios, the output floor will be phased in. I mentioned that at the very beginning. We're starting at 50%. So in the first year, 2023, the overall capital requirements must be 50% of what they would have been under the standardized approach if a bank would be using only the standardized approach. Then in 24, it's 55%, the next year 60, and so on. And after 5 years in 2028, we reach the final level of 72.5%. On the other hand, that means that there still is a benefit of 27.5%, so the difference between 100 and 72.5 that you can save on or by using internal models. So the benefit is not as high as it is today under CRR2, but it's still more than a quarter of the capital requirements that you would need if you were only using standardized approach. Another reason why the regulators want you to do the standardized calculation in parallel is that everybody has the figures to compare from bank to bank, because everybody will be using the same standardized rules. And so for that, it's not only the calculation to have the framework for the output floor, but the capital requirements that would be resulting from using the standardized approach are also part of the Pillar 3 disclosure. So you must calculate the capital requirements according to standardized and internal model in parallel. On the next slide, we see how it works in detail. In the middle of this slide, you see the applicable standardized approaches. So that's the basis for the comparison. And there you take all different approaches that are available. So you have the standardized approach for credit risk, CRSA. You have the standardized approach for counterparty credit risk, which is introduced via CRR2. Then for CVA, you have several choices which qualify as standardized approach. That's the basic approach, the standardized approach, or if you choose to use 100% of counterparty credit risk as the figure for credit valuation adjustments. Then when it comes to securitization exposures, you can use the R-bar, you can use the standardized approach, or the 1250% risk weight. They all qualify as standardized approach figures. Then you have the standardized approach for market risk and the new standardized measurement approach for operational risk, which replaces all currently used approaches. So this is the sum is the basis against which you compare the capital requirements by using internal models. So let's assume that these capital requirements mount up to 100. then by using internal approaches, the outcome must be at least 72.5% after the transition period. The figure against which you compare the 72.5% is the capital, the total of RWA using the internal models where you have supervisory approval to do so, and the standardized figures where you don't have the approval or where there is no internal model, like for operational risk. So if a bank only uses the internal ratings-based approach, but no other internal model, then the whole benefit of 27.5% can be used by credit risk. And depending on your portfolio and what business you engage in, the actual savings for credit risk can be up to 1/3, roughly speaking. Again, this will depend on the very individual situation of a bank. We clearly encourage you to do an impact analysis so that you know how hard you would be hit. But any bank which, as of today, saves more than 1/3 of capital by using internal models is very likely to be hit by the floor. On the next slide, I would like to do a quick calculation on how the floor works and why it is important that you familiarize with the floor, because we will see some surprising effects. So in this example, we have a bank which has the approval to use the IRBA for credit risk, for market risk, and for operational risk. This bank uses the standardized approach. We have in T0 capital requirements of 800 RWA for credit risk, 150 for market risk, and 50 for operational risk. So the total RWA for this bank is 1,000. And because there is a floor of 72.5%, this means that by using internal models, the capital requirements cannot be lower than 725. So as this bank has approval to use the IRBA, they do a calculation in parallel to produce the RWA under the IRBA. And in this example, it's 500. For market risk and operational risk, the figures are identical because there's no internal model in this bank. So before the floor, by using internal models, the capital requirements would add up to 700, which is 25 less than the floor level. So this means that the floor impact for this bank is 25, and they end up in T0 with total RWA after the floor of 725. Now let's assume that for the next reporting period, we see a change in market risk. This could be because we have market movements and the capital requirements increase. This could be because the traders did additional business and the new trades lead to higher capital requirements. It doesn't make a difference. But we assume that under the standardized approach, the capital requirements for market risk double. So from 150 to 300. In this case, we now have still 800 for credit risk, which is unchanged, 300 for market risk, and 500 for operational risk. So the new RWA under the standardized approaches add up to 1,150, 150 more than before. And the new floor level is 833.8. Now we do the same calculation for market risk and under the internal model approach. And as there is no internal model for market risk, we see the same 150 increase in RWA. Credit risk under IRBA remains stable. The same applies for operational risk. So before floor, we now have capital requirements of 850. And this 850 is higher than the floor level of 833.8. So the floor no longer applies, and we have total capital requirements of 850. So the delta, the overall change in total capital requirements is only 125. And that is a bit surprising because we see a 150 change in market risk. And the question is, to which business is the difference attributable? There only has been a change in market risk, but only credit risk uses internal models. But the total change in capital requirements is different than the change in market risk. So the bank will have to have an approach on who has to bear the capital requirements resulting from the floor. And they will have to have some distribution rules for any changes that apply to the floor. On the next slide, we have the same example, but in this case, the bank also uses an internal model for market risk. And what we see here is that from T0, we have no difference under the standardized approach, but we assume that for market risk, by using the internal model, the bank saves 1/3 of capital requirements. So the overall capital requirements for market risk by using internal model is 100 only. So we have under standardized 1000, leading to a floor requirement of 725. And by using internal models, we have total capital requirements before floor of 650, which is 75 lower than the floor. So the total capital requirements add up again to 725. Now we see the same change in capital requirements for market risk. Under the standardized approach, it goes up from 150 to 300, meaning that the new floor level again is 833.8. By using internal models, we take the same assumption, capital requirements double. So it goes up from 100 to 200. So we now have capital requirements before the floor of 755, which is 84 or 83.8 lower than the new floor level. Again, the result might be surprising if you first look at this, because the total change in capital requirements is 109, which is more than the 100 that we see as a change in internal models, and it also different than the 150, which is a change under the standardized approach to market risk. So this means that the overall capital requirements under the floor are different from the behavior that you see today. Also, the same question comes up. We see a change in market risk under the internal model, which is 100, and the total delta of capital requirements is 109. So we have a difference here of 9 units. And again, the question is, which business unit has to bear this additional change? So all banks which today use internal models, be it for credit risk, for market risk, or probably even for both business areas, will need a new approach for capital planning, capital management, and especially for the distribution of any change that we see in the floor. So what options are there to distribute the delta of the floor level? And for this time, we go back to the example that we had before. So we have a bank using internal models for credit risk and for market risk. And as we've seen before, the original floor effect was 75%, no, sorry, not percent, but 75 units of risk-weighted assets. What the bank could do is distribute it. And in this case, and it's just an assumption, this will be a political decision, something that the management of the bank has to agree upon. And we expect lengthy and hard fights, which business unit has to bear the impact of the floor. But we assume that the starting point will be the benefit of using internal models. So for credit risk, under the standardized approach, it would be 800. Under the internal model, it's 500. So this bank saves 300. For market risk, it's 150 under standardized and 100 under the IMM. So the market risk department saves 50 by using internal models. So the total benefit is 350, and the share would be 86% for the credit risk department and 14 for the market risk department. So this could be the basis for distributing the floor. And the other option would be to allocate it to that business unit which causes the change. And as we've seen on the previous slide, there's only change in market risk. So it could be one idea to fully allocate the change in the floor to the market risk department, because it has been changes in the market and the risk factors in the market which led to a change in the floor. By doing so, distribution 1 means that the total change in the floor of 8.8 would be allocated to the market risk department. If you share it 86% and 14%, 7.5 would be allocated to credit risk, and 1.3 would be allocated to market risk, because that was the share that has been agreed upon. On the next slide, we see that there are some problems that come along with this approach. This is a new example. Let me briefly explain what we have here. This bank has only got approval for the standard for the IRBA. So for credit, this bank uses internal models. For market risk and operation risk, the standardized approach. The starting situation is the one that we know. So we have a floor level of 725 and a total floor effect of 25. Now let's assume that from T0 to T1, we have changes both in credit risk and in market risk. It does not affect the standardized approach for credit risk, but ratings have been adjusted. So capital requirements for the IRBA go up from 500 to 600. At the same time, we have a small change in market risk, and capital requirements go up from 150 to 170. This means that the new floor level is 739.5, and by using internal models, we now have capital requirements before floor of 820. So we have no additional floor impact anymore. So the overall change in risk-weighted assets is 95 only. Again, the question is how to distribute the change in the floor requirements. And for the sake of simplicity, it's only the credit department using internal models. So this bank has decided to allocate any change in the floor to the credit risk department. So if we would use option 1 and distribute it by changes relative to the overall capital requirements, this would mean that 20.8 of the floor change would be allocated to the credit risk department and 4.2 to the market risk department. The second option where the credit risk department has to bear all the changes, the full impact of 25 decrease would be allocated to the credit risk department. Now, and that's the key message here. We have another calculation in T2. And here we have no change in credit risk and an additional increase of 10 for the market risk department because of another change in the market. In this case, the overall capital requirements for market risk go up to 180. We're already above floor level, so this has no additional impact on the floor capital requirements. So there's no need to distribute the capital requirements change in the floor because there is no change. What is surprising though is if we directly compare the capital requirements of T2 and T0, we come up with different results because we now have a change of 600 to 500 under the IRBA. So 100 change of capital requirements for credit risk and 30 for market risk. The total change in the floor requirements would be 25. And if we now distribute it based on the relative change, we come up with 19.2 and 5.8. And this is a different number than if we had the step in between comparing T1 and T0. So if you base the distribution of the floor on relative changes, the calculation order will determine how you distribute it. This is completely unpredictable for the business units, especially as credit risk will not know what the changes in market risk are, and market risk will not know what the changes in credit risk are. So these business units would not be able to predict what any change would mean for their business. If you have a predefined relationship, how to distribute the changes in floor, it doesn't matter in which order you do the calculation. For the sake of simplicity, credit risk here takes every single change in the floor. The outcome would be the same if you would allocate, let's say, 10% or 20% of the change in the floor level to the market risk department. If you have a fixed distribution rules, then the outcome would always be the same. And in this case, it's directly attributable and the calculation order has no impact on the distribution of the floor. So the key message here is if you are using internal models and if you will be hit by the floor, you will need a clear set of rules how to allocate any changes in the floor. We have done some analysis here. For time reasons, I cannot go into details, but there are 2 or 3 key messages on the next slide, which I would like to point out. The first one is there will be additional capital requirements resulting from the floor as soon as the floor becomes binding. So you will need additional regulatory capital, and this additional regulatory capital comes at a cost. And the cost should be considered in pricing any sort of return on equity calculations that you do, and it should also be included in capital planning and so on. If you include it in pricing, and I see no way to ignore it, there's one caveat. If you do not include it, you will not earn the cost of capital. So you will not earn enough money to really fully earn the cost of capital that you have in total. So you will be too cheap. This might be attractive to your borrowers, but you're not earning the cost of capital. On the other hand, if a bank finds ways to lower the capital requirements, or if a bank is not hit by the floor and can therefore make better interest rates for the client, and you choose not to give the benefit to the client, then your pricing will be too high. So you are likely not earning anything at all because the borrower will sign the contract with a competitor. So this is a lose-lose situation. Banks should know what the real cost of the capital will be under Basel IV. So we really encourage you to start investigating the topic as soon as possible to make sure that you know what the cost of capital is, and that anybody who's talking to the borrowers knows what the minimum interest rate should be covering the cost of capital. Then second, the order of calculation steps is important. You should avoid any solution which is based on assumptions on the order of calculation, meaning that you need to have clear distribution rules, a fixed base against which you compare the capital requirements. And this, as I pointed out before, means that there will be political discussions. No business unit is keen to have higher capital requirements than previously. So this is something that needs to be addressed internally. And you must have an answer here, because without knowing which business unit has to bear the floor, you will not be able to do the pricing calculations. And then the final point, the floor level is difficult to anticipate. It's not yet in capital planning. It's not yet in risk management. So you should start early to get used to it, to get a rough feeling of what does impact the floor level, what options are there to anticipate what the floor level requirement will be at the next reporting date. You shouldn't start too late here, because if you don't understand how it works, it's pretty difficult to manage and control the floor level. So again, you should start rather sooner than later. On the next slide, I would like to talk a bit on the practical implications. Eva already said that it's very hard to predict what the capital requirements under Basel IV will look like. The impact analysis that the BCBS and the EBA have conducted lead to very different results. Some banks expect to be winners. The capital requirements they expect will be lower than as of today. Other banks expect higher capital requirements, in some cases even significantly higher capital requirements based on the new rules, and the main drivers here are LTV. So banks which typically have not so favorable LTV ratios are likely to expect higher or significantly higher capital requirements, and also specialized lending. We see in some cases significant increase here under the standardized approach. So these banks will be hit, and every bank should have a closer look at the business portfolio, at the products. Where do you think you will be able to earn money in the future, or are there any portfolios which don't look attractive anymore and where you want to withdraw from that part of the market, especially if you take into consideration the additional floor impact that these business portfolios will have. On the next slide, there's another quick example, just to explain a bit on the mechanics of the floor and what drives the floor. And for this portfolio, we assume that we have total EAD of 1 million. And for the standardized approach, we have an average risk weight of 100%, and for the IRBA, we have an average risk weight of 65%. So under the standardized approach, the risk-weighted assets would be 100, and under the IRBA, it would be 650,000. So the floor of 725 applies, and the additional capital requirement resulting from the floor is 75,000 units. What I would like to demonstrate is how one additional deal will impact the floor. So in the first example, case 1, we have one additional loan, which comes with EAD of 1,000, risk weight under the standardized approach of 100, and a risk weight of 50% under the IRBA. So now in case 1, the total risk-weighted assets add up to 1,001,000, and the new floor level is 725,725. So that increases by 225. And the overall change in capital requirements, so the change in IRBA and the change in the floor adds up to 725. The same happens if one deal matures, for instance, or if you sell a loan of 1,000, and this loan under the standardized approach, let's assume, has a risk weight of 100% and 150 under the IRBA. Sorry, this is an additional loan, and what we see is that now we have a change under the IRBA of 1,500 in risk-weighted assets, and the impact of the floor now is only 74,225. So this one decreases by 775, and the overall change is again 725. Cases 3 and 4 are deals which mature or which are sold, and so the total RWA are reduced both under the standardized approach and under the IRBA. The effective change, adding up the change in the floor and the change under the IRBA, is always the EAD multiplied with the standardized approach risk weight. So it is the risk weight under the standardized approach which drives the total capital requirements. And this is true in every case as long as the floor applies, with one exemption. If this marginal deal means that the floor no longer applies, then the effective delta is something in between. But otherwise, as long as the floor applies, the net change in total capital requirements will always be driven by the standardized approach. So in that sense, the IRBA in the future serves as proof for the regulators that you are entitled to a rebate of 27.5% on internal models, but the overall capital requirements will be driven by the standardized approach. And if you are too generous here, if you don't have the same quality of implementation under the standardized approach, then the overall capital requirements will be exaggerated. So I just get the hint to finish the presentation. Let's continue with the timeline. As I said, the standardized approach drives the overall capital requirements, and we don't know yet what the overall capital requirements will look like. We have to wait probably until January until we see the draft. But because of the impact on the strategy, the impact on the capital requirements driven by the floor, we really encourage you to start the analysis now. And please bear in mind, can we move to the next slide? Please bear in mind that most deals, most loans that you negotiate with your borrowers right now will have a maturity that will last well into 24, 25. So at least some time of the duration of the new business will extend into that time period where the CRR3 is applicable. And if you don't know what the capital requirements will be for that particular loan, it will not be possible to earn the cost of capital. So you should start with the impact analysis when the CRR3 draft is available, to understand whether you will be hit by the floor or not. If not, there probably is opportunity to gain some business. If you are hit, you should analyze whether you have sufficient capital to meet the future requirements, or whether there is need for portfolio optimization, like selling parts of the business, doing new loans and so on. And also analysis whether there is benefit of internal models. Actually, we have spoken to several banks which are currently using standardized approach for credit risk, but because of a significant increase of capital requirements under Basel IV, they are considering to apply for the IRBA because there still is the benefit of up to 27.5% by using internal models. So this remains a means of lowering overall capital requirements. So ultimately, before going to the panel discussion, there is the question: is the IRBA still an attractive alternative? And Eva already explained that the IRBA will not remain available for all portfolios. There will be no IRBA at all for equity exposures, only the new standardized approach. For most other portfolios, the foundation IRBA will remain available, with the exemption of large corporates and exposures against banks. For these exposure classes, Basel has no option for the advanced IRB, only the foundation IRB. What's completely missing here is sovereign exposures. The Basel Committee has not included the future capital requirements for sovereign exposures in the Basel IV document. I assume, and that's just my private opinion, I assume that for sovereign exposures, the advanced IRBA will also not be available because there are not that many sovereigns around. Defaults are rather seldom, and that makes it extremely difficult to estimate LGD for sovereign exposures. The same is true for bank exposures and for the large corporates. That's the reason why the IRBA, the advanced, is not an option in the future, but the foundation is, and the foundation is still quite attractive. On the next slide, we have just a few points of consideration why the IRBA could be an option. The IRBA is still more risk sensitive than the modified standardized approach, which means that it is closer to Pillar 2 capital requirements. So using the IRBA makes it easier to align regulatory and economic capital requirements. On the other hand, the 1.06 scaling factor will be removed. Under the foundation IRB, the standard LGD is lowered from 45 to 40%. So under the IRBA, in the future, many banks will see lower risk-weighted assets. At the same time, the output floor will be introduced, limiting the benefit. But again, it can be up to 27.5% lower than under the standardized approach. And if a bank only uses the IRBA, the savings on credit risk could even be higher than that because you don't compare IRBA and standardized, but you would compare on the total bank level, which leaves benefit for other banks. Also, many banks currently already use existing rating models, which can be used for IRBA application. Most banks wouldn't be starting at a greenfield. So if you have a rating model that is already used within the group, or if you are using rating pools, we see that a lot in Germany, the application for IRBA can be quite attractive because you would save money or save regulatory capital here. On the other hand, having the IRB and applying for the IRB comes with cost. You need to develop the models, which means you have to do a thorough analysis on the data, on the rating model, the processes in which the rating models are embedded, IT system reporting. You must demonstrate to the regulator that you meet the use test requirements. And in almost all banks that we have supported, this required to some extent changes to processes, models, and IT systems. So you need a budget for that. Depending how good your models are, this can be a bit of money. It could be a larger budget that is required. And then, of course, the auditors come. They do the on-site inspection to look at the rating models before granting approval, and they will send you an invoice for this approval process as well. So you have to make an investment. Also, running the IRBA models means that you have to demonstrate on an ongoing basis that the models meet the requirements. You need to do back testing, you do validation, and you have to do this on a very good level. So you don't get it for free, but you can save money. The same question has been asked by other banks. Can I withdraw from using IRBA models? Officially, this is not an option, but if you can demonstrate to the regulator that the cost of having the IRB models is too high in relation to the savings on RWA, it is possible that the regulator will allow you to not use the IRB model for a portfolio any longer, or probably altogether converting back to the standardized approach. But just saying to the regulator, we don't save RWA anymore, so we don't want to do it, probably will not convince the regulators. You should always make a reference also to the cost of running the systems. So there's not an easy answer here, and every bank may come up with different answers on whether or not the IRB will remain attractive will become attractive under Basel IV. So that was what I wanted to explain in detail, and I assume that we now have questions from the audience and a discussion.
Thank you very much, Michael. Thank you very much, Eva, for this interesting presentation. I hope our panelists also, found a lot of interesting analysis and detailed calculation. Now we are starting the panel discussion. We had slides changed in the moderator and the panelist group. We have Ewa Winiarska that replaced Dimitrios, but we also can benefit during our discussion with different, let's say, geography and different experience we bring to the table. So regarding the Basel IV or Basel III, because this, let's say, number is, let's say, sometimes described a little differently, we see it's coming. There can be some kind of delay or impact of COVID, but no matter what happened, we all believe it will come sooner or later. We also see that whatever is placed on the paper, whatever the result will be, it will have impact on RWA, and we already discussed it. But also, very big question for practitioners is how it will impact the workload from the bank perspective, how much effort we need to put to implement these changes. And this is the place where we would like to start the first pull question to our audience. From the workload perspective, which out of 5 changes will be, let's say, will require the most of effort? And waiting for your answers, we'll close the poll within something like 1 minute, maybe 30 seconds. Please vote. I will ask Eva and Michael also to elaborate how do you see it and which of these changes really will require the most effort. Eva, if you could try and maybe also guess what is your perspective. And in the meantime, if we could see the poll results, if they are available, we can see if that's also what we see under different geographies. So, Eva, if you could maybe comment, how do you see it?
For Poland, I think, well, we've got 2 point in times here, right? We've got CRR2 and we've got Basel III. So the first wave of changes is CRR2, and here I would say that FRTB would be probably more difficult to implement. So SACCR will come into force a little bit earlier, but because this is not, this is not not very, the portfolios that are affected are not very significant, and the changes are also easier to implement, I think, in comparison to FRTB. So between those two, I would say that FRTB, it's more like it's harder in terms of the merit perspective. So just the rules are more difficult to implement, and well, yeah, the impact also might be important. But if we are talking about the next wave, so Basel III, I think here in Poland the credit risk standardized approach would be the most important change, because most of the banks use this method. And here, as you could see, we will have quite a new additional information that we will need to use. We've got the change approach for unrated institutions and also for the counterparties for which we use external ratings. So we need to gather additional information. We need to build additional models or methods to assess those counterparties, and also the whole class of exposures secured by mortgages. So additional information, new methods, and also quite a significant impact, possible impact on the value of capital requirements. So regarding Basel III, I think this part would be the most difficult one.
Yeah, thank you very much. Michael, is it your perspective as well, or let's say you see it differently?
Yeah, I basically agree with what Eva just said. It always depends on the business model of a bank. Banks which are not really involved in market risk and which decide to go for the most standardized approach here, they don't have bigger issues with counterparty credit risk and market risk. So this can be really a problem for some banks. For others, it's not, depending on the business model. The new standardized approach, what we've seen is that most banks don't have the information at the moment that they would need to do a proper calculation of the new standardized approach. And especially many banks which are using the IRBA don't have any good calculation rules at all at the moment to do the standardized approach calculation. So the IRB banks will be hit by the standardized approach to be able to calculate the floor and to produce the numbers for Pillar 3 disclosure. So the standardized approach means it will have to be implemented by all banks. And for those which don't have any existing approaches here, it will be a big issue. For the other banks, it will be data collection, making the interfaces and so on. So it will definitely also mean work for these banks.
Yeah,
and operational risk, I agree, is not the biggest problem. The new rules, we didn't explain them here. The new rules are different than the current standardized approach, the basic indicator approach and the standardized approach, but they are similar, and the changes will only really affect the AMA banks because the AMA will be dropped.
Yeah, I agree that on standalone basis, sometimes we do not require significant changes or the new regulation, but on the other hand, the time is changing. And at the last part, we'll also discuss a little technological aspect. And definitely, the new time requires sometimes new solutions to the same, let's say, requirements, but we need simply just the answers much faster than previously. But all these changes, all these regulations usually address some issues that we have identified previously. So the same story is with the CRR and CRD, so CRR2 and CRD5, and later CRR3 and CRD6 are addressing some issues or weaknesses that we have identified. So let's see how our audience see the Basel IV, let's say, dealing with identified issues. If we could start the next poll, and maybe see what our audience think about weaknesses that should be addressed. So the question is, which changes introduced by the new regulation seems to address weaknesses of the current regulations? And please select just one question, one answer: own fund calculation and supervision over financial holdings, standardized or IRB approach for credit risk, counterparty credit risk, CVA and operational risk, or limited application of advanced methods in terms of scope and impact. So let's wait a few seconds and let's see how our audience see this question. Okay, so if I could ask, how do you see it from your perspective? And during the presentation, we also, spend a lot of time on IRB and weaknesses of IRB, but also maybe we'll start from Eva. Does it surprise you, Eva? Do you agree with this answer?
Actually, I think I do. So, because when we are thinking about the changes, we are we are considering the areas which will affect us the most. So we are not looking just at the changes and whether they are actually making the regulations better or not, but we are considering also what would be the impact on the bank. And I think that for credit risk, because that's the most important risk for many banks, those changes are the most important ones. I would also say that the limitation of advanced methods is quite important, because definitely one of the weaker parts of the current regulations is that we've got very volatile values of risk-weighted assets, and values that are hard to compare between banks that are using advanced methods, and limiting it will make it more comparable. So I think that the two answers that have the most voices, I would definitely agree that this is the part that is most important.
Mm-hmm. So for many years, IRB was not only a way to decrease IRB, but also the way to, let's say, better managed and measure the risk. And we see that the changes to IRB is also one of the, let's say, considered as most significant. But we also have to admit that one of the main driver was the, let's say, ultimate benefit in RWA. So do you believe, Erve, that and Michael, that the introduction of output floor can result in withdrawal from advanced method of calculating capital requirements, or it's just the standard and we'll use it anyway? Erve, if you could comment a little, what is your perspective as credit risk leader on also what's in France? Erve, you are on mute. Hello, Erve.
See him, but we can't hear him.
Yeah. So, Michael, if you can comment in the meantime from your perspective, and I will try to.
Yeah, I think I already explained that there still is some benefit to the IRBA. The overall capital savings can be more than 1/4, so it is still attractive, but obviously the output floor limits the overall benefit. So it is still a valid option. It remains officially available, and as I said, we have spoken to several banks which are currently under the standardized approach and which seriously consider the IRBA to be one solution to the increase in overall capital requirements. On the other hand, it is interesting to see what the coverage ratio of internal ratings will be in the future. The original message from the BASEL committee was that there shall be no cherry picking, and that all portfolios ultimately should be under the IRBA. And what we've seen in discussion with the ECB is that the ECB is open to a smaller coverage ratio, so that banks will have to post most, but not all portfolios under the IRBA, which in my opinion makes the IRBA even more attractive, because for some smaller portfolios, the cost of IRB ratings can be quite high, and the overall capital savings for this portfolio, if the portfolio is small, will be very limited because of the business size.
How do you see it?
I would tend to agree to all what have been said just before. Maybe the only thing is that, as Michael introduced it also before, we have to see the capital requirements and the adjustment of Basel as one measure among others. And we also have to keep in mind that we have few other initiatives that has been that are in progress from the EBA and the ECB in the last month or year, regarding, for instance, the loan origination, regarding the monitoring on IFRS 9. And these two, why do I just mention these two ones, is that because when we are talking about loan origination, we have a lot of brand new operational constraints and other relatives to pricings that has been put on the front side, and that has to be handled quite quickly because it's before June 2021 by banks. And as long as you want to deal with that, you definitely need some useful and efficient models to deal with loan origination and then assessing credit quality at the origination. In the same way, if you are looking at the exercise of monitoring the implementation of IFRS 9 that has been handled by the regulator, there is a clear, how can I say that, a clear attention that is put by the regulators regarding how the analysis of risk at the origination is a clear and acceptable and accurate measure to be used in the staging criteria for IFRS 9. Yes. And that means that there is a clear expectation that banks will develop this kind of models in the most accurate possible way to support both their provisionings, both their loan origination and monitoring of clients and contracts and so on, and then profitability. And I think that capital ratio is one of the components of profitability, but it's not the only one. And by the way, if you keep in mind that when we are talking about capital ratio and RWA, we are only relying to a 1-year time horizon, which is far from a profitability equation. Yeah. It's clear that it cannot be the whole scope. So we have to take that to keep that in mind. Anyway, for small, let's say small part of activities or very specific portfolios that are not that material for big banks, and for which the investment might be too heavy considering the expectation in terms of development, it's true to say that it can change a little bit the, let's say, the global equation and represent then an incentive to come back to a standardized method if they have developed IRB methods, because they don't need more sophisticated method on an operational way. And Michael reminded that in the very beginning of its speech, the rationale for IRB is not capital optimization. The rationale for IRB, it's operational efficiency, and then all the rest. And then, by the way, if you can gain some capital, that's fine. But theoretically, for sure, it's not supposed to be the, let's say, the initial parameter to move forward toward an IRB.
Just one additional comment on that one. If a bank would have poor rating systems and would not be able to properly address the credit risk in the portfolio, this bank would very likely see a higher SREP add-on. So if the rating models are not good enough, you will not save regulatory capital, but you are very likely to face additional capital requirements.
Yeah, I fully agree. So maybe in the meantime, we'll start the next question, the poll number 3. But I fully agree with what you said, but it's also worth to remember that developing all these, more complicated models and, the need to really be competitive at the market requires developing, more precise models, and having them is definitely a situation when you are pretty close to, let's say, IRB anyway, I believe. So having all these models in the future will give an opportunity to simply apply for IRB. And on the other hand, in order to understand the market, and understand what's going on, how competitors price it, we'll simply need to really develop something similar and understand how to behave in the future. Pricing is just one of the very important part of it. So no matter which method you are using, in order to be in the market and play with competitors to make, decision how to price something, anyway, it requires something which is pretty similar to IRB and make a lot of calculations. So let's see how our audience see the IRB future in their institutions. Do they plan any changes or in IRB implementation or not? So, as we see, no plans, no analysis yet. And what I really believe is that in the next future, it's strongly dependent on the market. We have countries where only few players or even no one have the IRB. On the other hand, having a global market where we can lend loans from, let's say, other jurisdiction based on the passporting or branch concept, we really need to make it more competitive and understand what's going on. And we have big markets that are much more, let's say, IRB covered than some others. But to be honest, that's surprising for me. So this IRB topic, I'm not sure, let's say, how it will go forward, but I believe that the more calculations will come. So we already discussed a little IRB, but we are also approaching the final part. So when we look at all these, let's say, topics, all things that we have to deal with during the BASEL implementation, we have to have in mind that behind it, there has to be something what we call IT solution or regulatory tech. So basically, the question is, does the CRR or CRD will be followed by changes in the IT solutions used to calculate it? And from, let's say, expectations and needs, Michael, do you see, that the new solutions require something different? And in the meantime, if we could also make the last poll that we'll make today regarding expected changes, yeah?
In theory, the new calculations are similar to what we have today. So it should be possible to use the existing solutions and only upgrade them so that they have the new rules. On the other hand, many banks as of today do the calculation at least only once, either for the standardized approach or for the IRBA. So these systems will have to be modified so that they can do both calculations. What we do not know at the moment, and that is really a big question that we cannot answer at the moment, is what will regulatory reporting look like in the future? For FinRep, we've already seen the data point model, meaning that you don't populate any templates and file the templates, but you have many, many more lines that you have to report, and these figures must be produced. The regulators are discussing modifications to the way that banks file and submit their reports. BIRD, the bank's integrated reporting directory, is one of the topics here. And if CoRep would also become some point of data point model, this, in my opinion, will in most banks require significant changes to the IT systems. So I could even imagine that some banks will decide to implement completely new IT systems for some parts of the calculation and reporting process.
Okay, and let's see pool results. So that's very interesting, because what we also see at the market, that one of the biggest questions that we see is whether the old system can be upgraded in the manner that will not only, fulfill needs in terms of regulatory reporting and how to calculate it, but whether it can do all this calculation in robust and fast manner, and whether it can make all calculations like stress testing, what if scenarios, and provide the answers within really few hours, not days. What we also see that many of the currently existing solutions were developed really, few years ago. So from technical point of view, we can upgrade them still to introduce these changes. We have seen it, but really many banks consider changes of the whole system in order to really make it robust, fast, and answer all needs, not only regarding reporting, but also regarding financial information, planning, and pricing. And that's very interesting. And that was also one of the questions, the few questions that goes from audience regarding IT solutions and how does bank deal with this changes currently. So my understanding is that most of the banks, based on this pool, plan to upgrade old system, and that's very interesting, because what we have seen regarding our audience, we have seen that people from over 40 countries registered for this event. So we haven't checked how many countries is represented today, but as you can see, we believe that many changes origins from different jurisdictions and different approaches at different markets. So that's also what is very interesting. Even though the regulation seems to be very similar, we as Deloitte observe different plans and different strategies at different markets. So even though we are still becoming more and more global, the differences still exist, but I believe the convergence and the competitions will, let's say, require more significant changes.
Yeah, Przemek, I would say that if I can add something here,
yes,
I would say that the problem with the current IT solutions that banks use usually is that they are not very flexible. And because of that, even changes that are not very, very significant would cause the need to significantly upgrade the system. And upgrade doesn't mean that we just install a new version and then everything works correctly. It means that there is an actual implementation project required to adjust the system to the new regulations. So whether we are upgrading the current system or implementing a new one, probably the difference is not so important. Still, there needs to be much work done in order to have a system ready for the new calculations. We need to remember that we don't only need new methods of calculation, but we also need additional data, and that's usually quite a challenge to gather this data, to feed the system with this data, and then to test the system and make it work. And then what Michael mentioned before, the reporting requirements is like completely new area that if it is changed similarly to what is going to be done for FinRep, then we've got additional significant change to be implemented.
Yeah, so question is the evolution or revolution in terms of IT solutions behind it. And yeah, that's a standing question, I believe, and everyone has to find his own answer. We are approaching the end of our webinar. I hope our audience found it interesting. I would also take an opportunity to invite you for the next webinars. Tomorrow we are going to have next session that will cover regulatory aspects, REP, stress testing, recovery and resolutions plans. What does regulator think about it? What can be done in context of upcoming regulations, but also as response to COVID. Tomorrow's sessions will be led by Dimitrios Goranitis. So I strongly recommend to join this panel, and I also hope that you will enjoy it at least as today's and the previous meeting if you were attended. Thank you, big thank you to my panelists, guests from France, Paul Erwin, Michael Kluse from Germany, and Eva from Poland. I believe that was a nice diversity of geographies and experiences. We can see a lot of things common, but still few things different. That's it from my side. Thank you very much for joining us, and hope to hear you soon. Thank you.
Thank you. Bye.
Bye.
Thank you. Bye.